Matt, I saw kind of the negative net change here, but maybe can you provide some context first off, and secondarily, how does this kind of impact what you see moving forward from both the Trump admin, but also kind of the economy broadly?
Yep. So if you go back, you watch like the monetary policy, the FOMC press conferences, and you pay attention to what language or what inputs or which of the key objectives, the mandates of, say, the Federal Reserve with monetary policy, um, are the most in focus right now. What's the more operationally binding constraint there between those two mandates, full employment or stable prices, right? It's become very clear in 2025 that that risk has become full employment. A lot of this is coming from White House policy. You've got a changing of the guard, new sheriff in town, um, an objectively different policy path than what we were operating under in the Biden administration from 2020 to 2024 on immigration, budget, tariffs, et cetera. Right. So if you look at this chart, and this is the ADP employment survey, using this one because for during the government shutdown, we didn't get the numbers for the government or the federal government's the BLS, the non-farm payrolls report. So this is all we have. We also know, the BLS's NFP numbers are really model based. They're guesstimates. In my opinion, credibility is highly dependent on what the Treasury needs to do, the bond market to do. As the deficit situation, the debt situation has gotten into backed into a corner, and we need to carefully manage, interest expense as its share of tax receipts and the federal budget. So I think there naturally is some politics that go into that process as well. I don't know if it's not 100% political in terms of those data series. They're, it's very clear in the historical data. They're going to be deeply revised years after the fact. So there is some incentive there to have the numbers show what the supplier or the producer of those metrics wants or needs them to show. I think is not that controversial of a statement. But anyway, ADP numbers, they're private based on the modeling of one of the largest kind of payroll software operators, automatic data processing in the U.S. economy. So they're based on real data, not just back end estimates, birth death estimates of small businesses, just based on guesswork, stuff like that. But what you see since, especially Liberation Day, you see, Karen, I don't have the laser pointer on, but basically just go back to March 2025, where ADP report looked somewhat strong in terms of 100 to 150,000 jobs created. Basically, since Liberation Day, and the Trump administration has gotten its policy set started to be enforced, both on tariffs and immigration, the job creation numbers have started to look soft, right? And so what you're seeing with the November number that just came in yesterday was actually contraction across both the goods producing side of the economy, shedding 19,000 jobs, and then services shedding 12,000 jobs, for total private sector contraction of 32,000 jobs lost. So in this new era with the White House, I'll go through the labor force growth and what the trends look like in a second. But steady state of job growth when immigration policies has essentially scaled back to basically zero. You saw this with the Trump announcement, I think, over Thanksgiving, right? Like governing by tweet, if you will. Just another one of those blasts. I think he said immigration is suspended from third world countries, right?
Yeah.
If I'm remembering that correctly. So basically, we're looking at zero immigration on net, most likely, which kind of finds its way into stagnant population growth or very slow workforce growth. Um, So that's what you're seeing on the job front. And if you look at just monetary policy, interest rates, et cetera, this becomes your thing to watch. So this, if you notice, like once we get into September, the cuts started again. We got a cut in September, cut in October. Odds on we're going to get another cut in December. But if you look at the numbers, it's basically as soon as we saw that August softness in the jobs numbers, that's where Fed policy, shifted towards, hey, we're going to get back to resume cutting again, and it's really tying back to this slowdown in job growth in the U.S. economy, right? Um, Everything kind of plays into this picture. The AI growth engine running up against the economy's available supply of resources, all of that. But it just basically shows where we're at in the cycle. And right now, that cycle looks like short-term rates want to come in, and we'll see what that means for longer-term inflation expectations, further out on the yield curve. My baseline assumption would be to watch for, further steepening on the yield curve. I don't have the 210 chart on here, the 2-year to 10-year yield curve spread, but basically that's measuring the slope of the yield curve. Remember, 2-3 years ago, everybody on Twitter or X, topic of the day or on everybody's mind was the massive inversion on the yield curve. What that was doing was contracting money supply. We're almost back to, or we are back to a positively sloped yield curve. We're waiting, after the next few cuts, you should start seeing a fully normalized or positively sloped yield curve throughout. But in this kind of intermediate time between Liberation Day and basically, the time of this recording, that positive slope has stalled out, and we're just waiting for further cuts to re-engage that steepening in the yield curve. When that happens, credit creation takes place. That should shift, or should, right, is the hope, if it's effective, should shift the economy back into or financial, or sorry, it should shift the financial system back into balance sheet expansion and credit creation, which should hopefully tilt the real economy back into job creation, spending, consumption, et cetera. So that's what we're looking for on the backdrop. And this is the final thing. We'll close with this. If you're looking at the ADP private non-farm payroll survey, I think it's very clear now you're looking at a workforce that's an American workforce that's changed significantly in the post-COVID environment. If you look from 2010 to 2019, this is non-seasonally adjusted numbers. So you see the natural cycles of hiring layoffs after the Q4 holiday season. That's why we bottom out in Q1. Exactly. And then you ramp up, escalate into, Q3, the hiring gets done. Everybody ramps up for that last section of the season where Q4 tends to be your best quarter of the year for most businesses, especially the cyclicals. But in the post GFC up until COVID environment, we were looking at basically a workforce growth rate of 2% annually. It's tied to jobs, job creation, and population growth. What you're looking at, post COVID, once you get out of the divot and you let all the stimulus policy work its way through, both monetary policy and fiscal, what we're looking at since 2022 is a growth in the workforce of basically 1.2%. So it's shrunk by, something like 40% in terms of the growth rate of the U.S. economy. That is significant. We're going to continue to deal with that for the next decade ahead. That's another one of these core trends we talk about. But at this point, those, cyclical job losses, recession, et cetera, that's the thing, in my mind, that Fed monetary policy and the Treasury itself are front and center, focused on in terms of their objective. So that's why you'll get rate cuts into a backdrop that isn't showing, short-term price rises or cyclical inflation, But over the post 2020 backdrop, and this is what it looks like, in my opinion, what we saw in 2022 with this price hikes. And I think you're continuing to see it in the prices of metals, right? You see the metals as your first level input in commodities, not just precious metals with gold, which is more of a currency, but industrial metals, silver, copper, et cetera. Those are starting to ramp up. Those inflationary pressures are definitely there. You're going to continue to see a debasement or loss of purchasing power in your credit unit's ability to maintain their uh, ability to buy goods and services that you've been used to. But this goes back to what we talked about with the Italy gold situation. The better reserve currencies, the ones that are hard backed in this case, are the ones that are going to or expected to perform better or stronger in this new backdrop we're in the post-COVID world. So continue to watch that. November's jobs print, 32,000 loss. It's kind of like you automatically expect the job cuts to start to come in after we're done with that holiday kind of Christmas season rush. They're already going to come in January. But in this case, the worry is, hey, they've already started even a little bit earlier, which is kind of signaling, oh, things might be a little softer than even we thought. Let's cut. So that's kind of the balancing dynamic you're looking at here from the domestic or U.S. perspective.